The great rotation is well underway as investors vote with their feet, whilst first-time buyers are getting greater incentives to buy into the market at its peak. Welcome to the Property Imperative Weekly for the 3rd of June 2017. Hi, I'm Martin North, Principal of Digital Finance Analytics. In this week's review, we look at changes at mortgage interest rates, new first-time buyer incentives, and new findings from our core market model, freshly updated to the end of May. We saw a litany of rate hikes during the week, and other changes to lending conditions. On Monday, NAB reduced the maximum LVR for interest-only loans from 95% to 80% for both owner-occupied and investor purchases. They also reduced the LVR for construction loans to 90%. On Tuesday, AMP Bank lifted its variable interest rate for owner-occupied loans by 28 basis points, and the bank also hiked fixed rates for owner-occupied and investment interest-only loans by 20 basis points. They also dropped the maximum loan-to-value ratio for interest-only loans from 90% to 80%. On the other hand, fixed rates for owner-occupied principal and interest loans have decreased by 10 basis points. On the same day, Westpac reduced the LVR for new and existing interest-only loans to 80% across the board, including both owner-occupied and investment loans. They also said they would no longer accept new standalone refinance applications from external providers. But they waived the switching fees for borrowers who wanted to shift from interest-only to principal and interest loans. On Wednesday, NAB offered new white-label principal and interest mortgages through its Advantage wholesale funder, with a maximum LVR of 80%, including a 4.24% loan for residential investors. On Thursday, Teachers Mutual brought out a new hybrid combination mortgage, which limits the amount of the loan which can be interest-only. They also increased the interest-only loan rate by 40 basis points. And on Friday, Bankwest, the CBA subsidiary, announced a new LVR band at 95% plus, with a mortgage rate of 5.29%, up by 0.75%. Other lending will be capped at 95% LVR. So mortgage rates continue to rise, especially for interest-only loans and investors, and underwriting standards continue to tighten. Many households will see their repayments rise again, despite no change in the RBA cash rate, so adding to their financial stress. This week we got the April lending data from the RBA and APRA. The Reserve Bank said housing lending rose 0.5% in the month, or 6.5% over the past year, to $1.66 trillion. Within this, owner-occupied loans rose 0.55%, while investment loans grew 0.36%, and another 1.1 billion of loans were reclassified by the banks, making a total of 52 billion, which is nearly 10% of the investment loan book. This ongoing switching should be concerning the regulators, because it means that either bank data is just wrong, or borrowers are deciding to switch an investment loan to an owner-occupied loan to get a lower rate. But we wonder what checks are being done when this occurs. The proportion of lending to productive business fell again, so housing lending is still dominating the scene to the detriment of the broader economy and sustainable long-term growth. APRA showed that the banks lifted their investor loans by 2.1 billion in April, though all the majors are well below the 10% speed limit. The quarterly property exposures showed a fall in higher LVR lending, but interest-only loans still well above the 30% threshold APRA has set. But weirdly, APRA warned that we should not use these statistics to assess the impact of their latest moves, because the reported data is based on approved loans, whereas their measure is on funded loans. So plenty of wriggle room and more fog around the data. Talking of wriggling, Wayne Byers gave evidence to the Senate Economics Legislation Committee, and under sustained questioning said alarm bells were ringing on home prices and that we had entered a high-risk phase. It's worth watching the video of the session, which is linked on the DFA blog. The regulators continue to be coy about the issue, which, by the way, is confronting many other countries too. The truth is, the financialisation of property is the root cause of the property bubbles around the world, and it will be very hard to tame them. Australia is not the only country with a bubble. Amid all of this mayhem, and with bank stocks under pressure relative to the rest of the market, New South Wales released their Housing Affordability Plan. New South Wales has perpetuated the quick fix approach to housing affordability, alongside taxing foreign investors harder and making changes to planning. The removal of stamp duty concessions for property investors may slow that sector, but the fundamental issue is that supply is not the problem many would claim it to be. First-time buyers are potentially able to get up to $34,360, but we think that this will just push prices higher. The new arrangements start 1 July, so we expect a slowdown in June. With the enhanced incentives in Victoria and Queensland also coming on stream, we're expecting a pickup in first-time buyer demand as investor appetite slows. Our latest surveys show this rotating trend, and we'll be publishing the detailed findings in the next few days. But already we see some investors are selling to lock in capital growth, and some first-time buyers have renewed their search to buy on the back of the new incentives and greater supply. Meantime, there was further evidence that property prices are indeed drifting lower. According to CoreLogic's Home Value Index, they fell in Sydney and Melbourne over the past month by 1.3 and 1.7% respectively. It is becoming increasingly clear the momentum is easing, so it is now just a question of how far it eases down and whether prices go sideways or fall significantly. We expect mortgage rates to continue to rise. ANZ said their new APRA risk weight for mortgages was now sitting at 28.5%, which was at the top end of expectations. But whilst this is higher than the sub-20 lows, it is still significantly lower than the regional banks' capital weights, and even allowing for the bank tax, they remain at a capital disadvantage. We think APRA will lift capital weights further down the track, and when we take account of expected US rate rises also, mortgage rates will continue to climb. This feeds into and reinforces the potential slide in prices. Whilst first-time buyers may take up some of the slack, we think the market dynamic is morphing into something rather ugly. And that's the latest Property Imperative Weekly. I'm Martin North, Principal of Digital Finance Analytics. Thanks for watching, and check back next week for the latest instalment.